What is convexity? Convexity measures the relationship between bond prices and bond yields, serving as a tool for managing risk and assessing portfolio exposure. It gauges how bond prices change as interest rates fluctuate and acts as a good indicator of how bond duration shifts in response to changes in yield. In mathematical terms, convexity is derived from the duration equation. The first derivative measures duration, while the second derivative captures the fluctuations in bond prices due to changes in interest rates. Since bond prices are influenced by various factors, including interest rates, convexity helps assess the sensitivity of a bond's duration to these yield changes. Essentially, convexity evaluates how bond price volatility responds to interest rate fluctuations, providing investors with insight into potential bond price movements. When bond yields increase, bond prices typically fall, and vice versa, reflecting the inverse relationship between bond prices and interest rates. Bond duration measures how much a bond's price is likely to change in response to shifts in interest rates. A bond with a higher duration tends to show a larger price movement in the opposite direction of interest rate changes, while a bond with a lower duration exhibits less sensitivity. Factors like yield, coupon rate, and maturity affect the duration of a bond. For example, with the same coupon and yield, a bond's duration increases as its time to maturity lengthens. Similarly, if maturity and yield are constant, a decrease in coupon rate leads to an increase in duration. Lastly, if coupon and maturity are the same, duration increases when yields fall. Convexity can be positive or negative, depending on the bond's price sensitivity to interest rate fluctuations. Positive convexity occurs when bond prices become less sensitive to changes in yield, benefiting investors by reducing price volatility as yields rise. In such cases, bond prices increase more with a decline in yield than they decrease with a yield rise. Negative convexity, on the other hand, indicates that a bond's price falls at a faster rate as yields rise, which can disadvantage investors. Bonds with negative convexity, such as those with callable options, tend to have more price volatility. Interest rates and bond prices share an inverse relationship. As interest rates rise, bond prices generally fall, and when interest rates drop, bond prices increase. This dynamic presents a common risk for bond investors. Convexity helps investors understand how sensitive a bond's duration is to interest rate changes, allowing them to predict how a bond's price will respond in various market conditions. Convexity, therefore, is a valuable tool for assessing bond price fluctuations in response to interest rate changes, helping investors make informed decisions and manage risk more effectively.